Hello and welcome once again to MBAbullshitDotCom. So our topic for this video is understanding call options. Remember, you can always go back to MBAbullshit.com. Alright, so let's get down to it. So in order to first understand call options, I'd like to start with a story. Okay? Let's say there was a man who was interested in a share of stock in the stock market. And the stock is now worth $100 in the market, and he might want to buy it in the next 5 years also for $100. However, he's afraid that it might be more expensive in the future and might cost him more than $100. So, what should he do? Okay? Suddenly he remembers that he knows a rich lady and that he can pay her $1 to make a contract with her. Alright, so this is the contract on the right side. And in the contract, she guarantees that she will sell him the stock for only $100 anytime in the next 5 years if he wants. Alright, so he's not forced to do it, but he can do it if he wants to do it. He can buy the stock for only $100 in the next 5 years if he wants, and she will sell it to him. Okay, and they write that agreement down in this contract over here. Okay. Alright, and she guarantees that she will sell him the stock for only $100 even if the stock price goes up to like $200 or $300, whatever. Okay? And one more thing. Let's say that this man is allowed to sell this contract, okay, to somebody else who can use it. Maybe he changes his mind and he doesn't want to buy this stock anymore, and so he doesn't need this contract anymore. Maybe he can sell it to somebody else, like to me over here. Okay? So far so good. It's pretty clear. Question. What is this contract now called? What do we call this contract? I'm sure you can guess. It is called an options contract or an option contract. Okay? So this man now has the choice, now has the right, or now has the option to buy this stock, okay, from her for the next 5 years at $100, even if the price goes up. Okay? Specifically, this contract over here is called a call option. Okay? It is called a call option. It is the man's, okay, in this case, it is the man's option to buy a share of stock at a given price, $100, for a certain amount of time. In our example, it's 5 years. Alright? And the lady here, okay, is called the issuer of the option. So, she earns $1 because the guy paid her $1 in order to motivate her to agree to the contract. But then she also bears the risk in exchange for the $1. Okay? So, very important. Don't be confused with the buying and selling of the options contract, okay, which happens right now, versus the buying and selling of the stock, which is possibly in the future if the man wants to use the contract. Okay, so don't confuse those two things. And another thing, when I said that the man might use the options contract to buy or sell the stock, okay, in MBA bullshit language, we say exercise the option. Alright? We say exercise the option. So if an MBA bullshitter says, "Oh, I exercised my options," and he sounds so intelligent or whatever with all that bullshit, he's just saying that he used the options contract to buy a share of stock or to sell it, okay, depending on what kind of option it is, and more on that later. But all I'm saying is that if you use the contract, if you take advantage of your options contract, we say that you exercise the option, okay? And if we say that the option is good for 5 years, then we can say that the date at the end of the 5 years is called the expiration date. So it's like a carton of milk which expires, or food which expires. So we say that the options expire in 5 years. Now, very, very important, okay, very important, I said that this man can use the option or can exercise the option any time in 5 years, right? But actually, in Europe, it's a special case. In Europe, if you use options there, you cannot use it any time within the next 5 years or any time within before expiration. In Europe, you must exercise it or you must use the option only on the expiration date itself. Alright, so be very clear about that. Okay, and the other thing is we kept on talking about this $100 that the man might buy the stock from the lady, right? Okay, this $100 that he might buy is called the strike price in MBA bullshit language. And don't confuse that with the option price, okay, which is simply the $1 that he paid the lady in order for the lady to agree to the option contract with him. And lastly, take note that in real life, the man and the woman, that old lady, do not deal directly, and instead options are traded on what we call an options exchange. Alright, so remember that. Alright, so now that you understand that, you're ready for our next video on put options. Okay, if you haven't watched my other video yet on put options, please watch it. And if you've already watched both my videos on put options and call options, which was this video right now, then you're ready for the next easy video on valuing options at expiration date, which answers the question, how much is an option worth at expiration date? And you can watch that at MBAbullshit.com. Alright, so I hope you learned something. Please share it if you like it. On Facebook, we are facebook.com/MBAbullshit. Same on Twitter. Or simply forward our YouTube links on your email. Alright, so have a great day and goodbye.